Hello, I'm David Buckland, CEO of Montgomery Investment Management, and welcome to this week's Video Insight. In recent months, there has been another step down in interest rates, with US $15 trillion of government bonds and some corporate bonds with negative interest rate yield. And 12 countries, including Switzerland, Germany, Denmark, the Netherlands, Austria, France, Finland, Sweden, Belgium, Japan, Slovakia, and believe it or not, Slovenia, have now got negative yield on their 10-year bonds. You too can pay Euro 102.64 to acquire a Federal Republic of Germany government bond maturing in August 2029 when you receive Euro 100. That is an annual yield to maturity of negative 0.26%, and you receive nil interest on your investment over the 10 years. Central banks have been bordering on obsessed in robbing Peter or good savers to pay Paul, or those governments, companies or households who may live beyond their means. Over the decade since the global financial crisis, and despite record low interest rates, central banks are fighting a relatively low growth and low inflation environment, and they don't seem to be winning. This is attributable to ageing Western world demographics, technological advancement assisting in the cost reduction for businesses and greater transparency for pricing, and globalisation via the continuous shift of manufacturing to low-cost destinations, combined with an increased supply of relatively well-educated labour from lower-cost countries. These factors have generally been quite deflationary and have benefited many strongly growing businesses with pricing power. Despite relatively low unemployment levels, these factors are causing disruption across the Western world workforce. Together with casualisation and little growth in real wages, many people are logically feeling less secure. When retirees in Australia, for example, see the return on their term deposits coming down from an average of 6% for the 2 decades leading up to the GFC to the current 1%, many savers are fearful of their current financial situation and have to eat into their capital to survive. According to Rob Capito from BlackRock, over $50 trillion of cash is sitting in their clients' accounts, with the largest percentage of cash they have ever had. And while some commentators argue debt and asset prices are in a bubble, much of the cash sitting on the sidelines will be looking for a home if and when the opportunities arise. That's certainly what we're doing at Montgomery and the Montgomery Fund. Thanks for watching, and don't forget to follow us on Facebook and Twitter.